Okay, at time of recording, interest rates on mortgages are somewhere between 5 and 6.5% depending on your loan to value. Now, the Bank of England have just decided to hold interest rates, but they are still way higher than what they were 2 years ago. So with that in mind, it can be really tempting to look at any option to clear your mortgage as soon as possible. And in doing this, many have started to look at their pension as a simple solution. But wait, just because it might be an option doesn't mean it's the right thing for you. In fact, I found that when advising clients that many people aren't really considering the big picture and they can come very close to making a really expensive mistake. So today I'm going to go over the pros and cons, the tax position, the trade-off, and give you what I feel is everything that you need to know to make an informed decision. Even something that 99% of people don't consider when making this decision. So the first thing I think we need to understand is the cost of the mortgage. So let's going to keep this really simple. Let's say you've got a mortgage remaining and it's 100 grand and it's a repayment mortgage with 7 years left, which is probably about right for most people thinking about this on the assumption that you need to be 55 at the moment to draw on your pension. So if you're one of the hundreds of thousands who in 2023 came off a fixed rate, then your mortgage interest will have likely risen above 5%. If we assume it's 5.5% from maybe 2%, that is an increase to a monthly payment of £1,437 from £1,276, or simply put, £2,000 per year extra in interest payments alone. So that is a lot more money for the same thing. I mean, your house isn't getting any better just because you're paying more interest. And also, look, there's a peace of mind factor which isn't to be underestimated. If you're wanting to consider the build up to retirement, maybe dropping hours, the ability to not have mortgage payments is a big thing. And there are many clients I've spoken to who just feel they won't really be ready to even consider retirement until they've cleared that mortgage. So everything I'm about to say here has that caveat, which is, look, there are financial decisions and there are personal decisions, and making a good decision is about the balance between the two. And the second is just the trade-off if you take money out of the pension. So the first thing we need to consider is, do you have enough for retirement in the first place? Are we solving one problem and creating another? So the first thing we need to assess is, are we on track? Can you spare potentially tens of thousands of pounds from your pension to do this? Simply put, there's no good paying off your mortgage if it affects your retirement so negatively that you can't retire when you need to. So the first thing we need to do is consider this really carefully and assess this before we make any withdrawals, because tax-free cash or withdrawals from a pension are like toothpaste. Once it's out, can't go back in. But what happens if you can afford this without it necessarily negatively impacting your retirement? And a key question with your retirement is, are you planning to downsize later? And if so, when? Does it perhaps make sense to wait until that downsizing event to fully clear the mortgage? And what, in my view, we need to consider now is, well, firstly, we need to just look at what type of scheme you have. And what I mean by this is, what we need to understand now is, if you're looking to take tax-free cash from, say, a defined benefit scheme, where the rules of the scheme are in retirement you can take a full pension or a reduced pension and some tax-free cash. Well, if that's the case, we need to really carefully consider what is the impact of taking that pension. Because if it's a defined benefit scheme and you're taking the tax-free cash before normal retirement age, that's likely to reduce the pension income that they'll pay you for the rest of your life. It's what's called early retirement factors, which means in taking the tax-free cash now, you're also committing to that lower income for the rest of your life. So you're not only dropping the income, but likely the inflation protection that comes with the income. But most importantly, because you can't decouple the tax-free cash from the income elements, what you might be stuck with is a smaller taxable income, which you probably don't need because you're still working. So you could be committing to a smaller income which will impact you later that you don't need. That's a lot of stuff to give up for the sake of just paying off a mortgage. So think about that and if it's worth the trade-off. So that's kind of defined benefit schemes. What about defined contribution schemes? So this is a more flexible pot where you can potentially take some tax-free cash alone. Well, the first thing to check is, does your pension actually allow you to do that, and not just assuming they can? Because if it was a pension set up many years ago, it might not have the features to allow you to take tax-free cash on its own, which means the only way you might be able to do this is to transfer the scheme. but there are some big things to consider here I'm going to go into. So let's just go back to those retirement options. Look, an older policy, it might only allow you a purchase of annuity, which is a guaranteed income for life, or maybe just drawing the lump sum, which is tax-free cash and some taxable income. But even if that is the case, if you are considering transfer options, please be very careful and ideally seek advice. Because if it's an older policy, it could have valuable things attached like guaranteed annuity rates. Or perhaps it's an older, what's called a with profits fund, which has bonuses to consider. And if you don't check, you can just transfer sometimes and lose out. Okay, so there's some things to consider, but let's say neither of them are the case. Look, it's not a defined benefit scheme, and you do have the option just to take tax-free cash, and it's not got any kind of guaranteed annuity rates. The next more difficult to define question that 99% of people don't really think about is now a good time? And that is as vague as it gets. So let me explain. I've mentioned this before on a video about overpaying the mortgage. The challenge we have is that when interest rates rise so quickly, this has a direct impact on most investments. If you look at the global stock markets here, which I'll bring up, since interest rates started to rise so quickly since 2022, you can see the market has sort of gone nowhere for about 18 months in aggregate. There's been a lot of pain in the bond market because bonds are IOUs to companies and governments, and they're really sensitive to increasing interest rates. Let me just explain that. Imagine you had a 5% bond from UK Company Inc., and this was in 2021. At that time, inflation was low, and the UK government themselves would only really offer you next to nothing. But let's say it's 2%. The reality is, having UK Company Inc.'s debt, you get a 3% uplift compared to what the government would offer you. Now let's think through what happens if either inflation or what the UK government was offering is now 6%. Remember, the UK government's never defaulted on its debt, so it's the closest thing we have to a risk-free rate. How valuable is that 5% interest rate from that UK company now, which can go under, can default? Is that kind of thinking and those reasons why asset prices, be it stocks or bonds, tend to drop when inflation or interest rates rise sharply? And you might be thinking, okay, I know that, but what does that got to do with my mortgage decision? Well, if prices have recently fallen, what happens to future returns? The future returns have risen because now you're going to be buying an asset for a lower price. So it actually has a higher expected future return. And I can show you this from Vanguard here, which shows you how the expected future returns changed in 2022 when the market went through a decline. Or something somewhat similar from JP Morgan, which shows you historical returns 12 months after market declines. So while there are never any guarantees here, there's a weight of evidence to suggest that at the time when interest rates rise, which can make paying a mortgage off so attractive, it can also be a good time to stay invested, invest and get good returns. So if you haven't guessed it, this is why it becomes quite a tricky, very individual decision based on time horizons, what's important to you and what your personal trade-offs are. But there is another option you could consider I've not seen anyone mention, but just before I go over that, let's quickly just go over some tax considerations. Okay, so the first thing to consider is that in clearing your mortgage, you will be increasing the value of your estate, so potentially increasing inheritance tax. If you have a money purchase pension, that's one without a guarantee and it's just a pot, and then you take anything out of that pension apart from just the tax-free cash, so the taxable income, then the annual allowance for money purchase schemes can be reduced from $60,000 to $10,000, what's called the money purchase annual allowance, which if you're on the build up to retirement could have a significant reduction in what you can save going forward at the time it matters most. So something to be really careful on. But here's a question. What happens if you're on a fixed rate now and you want to clear your mortgage going forward, but you've got a 3-year runway? There's something I don't think a lot of people talk about. So that's when your fixed rate ends. Is it worth paying maybe an early repayment charge at this point in time? Well, could it be worth considering a funding strategy? Okay, so let's say we've got a higher rate taxpayer, and let's say that individual has sufficient annual allowance, sufficient relevant earnings. If you don't know what any of them mean, maybe watch this video. But what I'm trying to just say is they can, in this example, make some extra savings, bagging an extra 40% tax relief along the way in this example. and then drawing some tax-free cash later. So if I run through an example where an individual, they need to achieve an extra 40 grand to clear the mortgage and be fine for retirement. Assuming that in their contribution strategy they can remain at a higher rate of income tax and get relief that way, and then take the tax-free cash. If I show you some figures here, you can see actually the impact of how much they can potentially save and the uplift that getting the tax relief before drawing the tax-free cash can make. So it's very individual, but a bit more of an intentional strategy when you're planning in advance can be really useful if you are going to use your pension for this purpose. Now, there are a ton of rules around this to consider, and there are some risks here with this strategy, such as, look, if you invest in a pension, if you actually invest the funds, there's no guarantee in 3 years the return will be positive. Although that probably is a reasonable time frame to expect it, you could always place the funds into cash in this example, but then there's inflation, so it's hardly ideal. And while I hate mentioning it, it's important to say they could change the rules with tax-free cash. In my personal opinion, I think it would be a very brave government to do that, because there's the fairness angle of people who took tax-free cash previously, and there's a lot of historical weight on what's called transitional rules when they bring in something like this. And because tax-free cash is frankly one of the few things that most people understand about pensions, I'm just not sure whether they're going to do something which would be so much of a disincentive. But that's just my view. I'm not the government. So we're talking kind of potential funding strategies. But there is a trade-off in general in using tax-free cash for the purpose of paying the mortgage. It's not just obvious things like holidays, the car, whatever, but you can actually use tax-free cash to reduce the tax bill across your lifetime. So let's run through an example. Let's say we've got an individual who is 60 and wants £30,000 per year, and they're going to get a full state pension at state pension age. If we assume they've used all their tax-free cash and they just have a pension pot, a flexible one, then their income to sustain them over their life, they're going to have to take some taxable withdrawals to get that £30,000 after tax. And that means, just very generally, you're expected to pay about £4,300 tax each year in general, because there's going to be 20% tax to get the money out of the pension and you've used your tax-free element. Now, look, if that same individual has tax-free cash still available and they have a scheme which allows flexibility to draw this, and many modern pensions do, for example, the pensions in general I advise my clients on, they've all got this kind of structure. So yes, you're foregoing maybe, taking a lump sum, but you can also then take little chunks as you go to forego paying tax for many years into retirement. It has to work clearly for the individual, but it's a trade-off. Now, in both instances, you are still using your tax-free cash for a pension for something that's important to you, but one, you're reducing the income tax burden, and the other, you're clearing the mortgage. Neither are right or wrong. These are just trade-offs to consider. So look, in this video, I talked about returns and paying off a mortgage, but I do want to let you know, look, there's a ton of detail that I wasn't really able to conclude here without making it a really long video. But I did do a specific video on overpaying or investing, which also has a really interesting trip to the airport story, which I think will make your decision clearer. So if you're still unsure about this whole thing, give that a watch. I honestly think it's one of my best videos. Either way, look, I'm really grateful for you watching. See you next time.